Which one makes more money, trading or investing? You know, whenever the debate comes up, trading versus investing, which one really makes more money, I'm reminded of this conversation between Morgan Housel and Tim Ferriss. Tim asks Morgan to compare two names, Warren Buffett and Jim Simons. Morgan's take is fascinating. He says if your goal is longevity, if you want to see the raw power of compounding, no one can beat Buffett. But if you care about pure average annual returns, Jim Simons is in a completely different league. For me, Buffett is a classic fund manager story. He built Berkshire Hathaway over decades, grew assets under management into hundreds of billions, and delivered around 21% average annual returns. His whole philosophy was about time, patience, and giving his shareholders steady, predictable wealth. Simons, though, was a completely different creature. He didn't operate a massive AUM like Buffett, but what he did was extraordinary. His average annual returns are nearly 3 times that of Buffett. He wasn't trying to build a legacy or guide investors along the path. He was a math genius, a problem solver, someone fixated on optimizing for the highest possible returns and nothing more. So what do we make of both? On one side, Buffett shows us the unmatched power of endurance, an 80-year track record of compounding. On the other hand, Simon proves that with the right edge, you can achieve astronomical numbers even if over a few decades. And this is where it gets individually relevant for us. At our level, we've got to ask, what do we actually want to optimize for? Buffett-style long-term wealth that compounds slowly but reliably, or Simon-style returns 3 times as high but harder to achieve in many ways? Or maybe, just maybe, the answer lies somewhere in the middle. I'm your host Sandeep Rao, and in this episode we will explore the question, which one makes more money, trading or investing? As with everything, let's start with defining the terms trading and investing. I actually spoke about this in the trading versus gambling episode, but anyways, let's do a quick recap. In short, trading is all about short-term buying and selling of securities with the intent of closing the position within a year, sometimes within days and sometimes even within minutes. The goal is to profit from price movements rather than long-term business growth. Investing, on the other hand, is a long-term game. You buy and hold for years, sometimes decades, so that you can let the power of compounding do its work. Here, the focus isn't on daily price swings, but on steady growth of business and assets over time. So now that we know what trading and investing are, let's move to the next and probably most important question. When we ask which one makes more money, trading or investing, what does makes more money even mean? To answer that, we need to take a short detour through some fundamental money concepts. Because in this episode, I want to talk to you not as Warren Buffett or Jim Simons, but as an individual investor or trader, someone like you and me. Let me start from the source of it. So where do we actually get the money to invest or trade from? For most of us, the answer is pretty simple: savings. We earn an income, we spend on our essential living expenses, and whatever is left becomes our surplus, which is the pool of money we can choose to invest. Once we have that surplus, we are faced with the next problem. Where do we put the savings? The options are simple: traditional interest-bearing products like fixed deposits or equity products like index funds. But before we jump into those choices, let me ask a more basic and fundamental question. Why do we even want to invest? Broadly, the answer is we want our money to grow. And that leads to an even deeper question. What does grow actually mean? This is where the concept of inflation comes in. Forget about growth for a moment. Our first priority has to be simply not losing what we already have. For instance, if inflation is running at 6% and your money is sitting idle or only earning 4%, you're effectively losing purchasing power every year. So the very first goal of investing is to at least match inflation. Only after we've cleared that hurdle, the question of growing wealth actually comes into play. With that, I think our problem statement is pretty clear now. We need to find ways of putting our money to work so that it grows well beyond the rate of inflation. Otherwise, we are just running on a treadmill. And this is exactly where investing comes in, especially investing in equities. Over long periods of time, equities have consistently outperformed other classes, not just beating inflation, but compounding wealth in a way that very few alternatives can match. So if the question is, what should I do with my savings, invest or trade? The answer hands down is to invest first. That's the minimum. That's the baseline we all need to hit if we want to grow our savings and build wealth in the long term. Trading may or may not come later, but investing is an absolute non-negotiable. With the issue of investing settled, now let's talk about trading. At the heart of trading is the idea of leverage. What leverage allows us to do is to increase the efficiency of our capital. It happens in two ways. First is through the concept of pledging to get collateral margin. For example, if you have 10 lakhs, let's say in an index mutual fund, you can pledge and get up to 90%, which is 9 lakhs as margin. This 9 lakh is like a loan, a free loan if you will, barring some cost. In India, regulations allow this collateral margin to be used for trading in derivatives, that is F&O, or for intraday equity. But here's where it gets interesting. You can structure your 10 lakhs investment in multiple ways such that it allows you to do more with it. Let me explain with a few examples. Fair warning, I'm about to share an example of how you can structure your capital between investing and trading. This is purely an illustration and not a recommendation to trade. To keep things simple, the example leaves out certain nuances. And of course, both investing and trading involve risk and can result in losses to your capital. Another important point, the whole explanation can seem complex, but stay with it and you will get it. For example, if you have 10 lakhs in savings, there are 4 ways in which you can structure it. 1. Investing only for the long term in an index like Nifty. 2. Trading only with cash in your broking account. 3. Investing in a liquid fund plus trading using the margin. And 4. Investing in an index fund plus trading using the margin. Let me explain in detail. Let's start with the headers of this table. CAGR is the average return on the compounded capital. Absolute return is the total returns you make at the end of the period. Probable drawdown means how much you can expect your investment to go down at any point of time. Lastly, we have a ratio, returns divided by max drawdown, which is same as the probable drawdown we have assumed. The table gives you a broad sense of how the returns could play out, assuming you get a 10% CAGR on index, 6% on liquid fund, and 7% on trading. These are the return assumptions I have made. I've also made some drawdown assumptions. Look at row 1. It's just plain vanilla index investing with an assumed CAGR of 10%. End of 5 years, you get 60% return and your account value grows to 16 lakhs. Moving on to row 2. It's just trading with a cash of 10 lakhs in your broking account. I have assumed a CAGR of 7% and at the end of 5 years, you get 40% returns and your account value now is at 14 lakhs. So here's what we do in row 3. Suppose you have 10 lakhs to invest, you put 9 lakhs, that is 90%, into an index fund and keep 1 lakh, that is 10%, cash in your trading or broking account for MTM management. On the 9 lakh invested, you get 10% returns. On top of it, you pledge the 9 lakh investment and get 90% of it as margin, which comes close to 8.1 lakhs. Add the 1 lakh in cash and your total trading capital or margin becomes 9.1 lakhs, on which you earn 7% returns every year. So there are two things running parallelly. Your investment returns on 9 lakhs and your trading returns on 9.1 lakhs. At the end of first year, you keep 10% of your account value as cash and invest the surplus earned through trading back in the index fund. You repeat this process year after year. I've assumed a 20% drawdown for index fund and 10% for trading. Now you might ask, why only 10% in trading? Because since we have set aside 10% cash for trading, we take minimal risk to achieve the 7% returns post cost, taxes, etc. In row 4, I've taken a liquid fund as the base investment because it doesn't swing as much as an equity index fund would. The drawdown assumption is 0% for liquid funds and 10% for trading. As you can see, only investing performs better than only trading in terms of returns, while also involving fewer active decisions, even though the return to max drawdown ratio is lower in investing. Things get interesting between row 3 and row 4. You can see the 5-year and 10-year absolute returns and CAGR are higher in the index fund plus trading strategy compared to investing in a liquid fund or any other debt product with fixed type returns. But the return to max drawdown ratio is almost 2 times better with the liquid fund investing plus trading. And that's because the drawdown in liquid fund investing is much lower, closer to zero, though not exactly zero, but I've assumed it to be zero for calculation purposes. There's another way of looking at it. Most of you would already have money invested across equity and debt mutual funds, stocks and ETFs. You can pledge a part of that portion and keep aside some cash and start trading to see what I've explained makes sense to you. It's always a better approach to first try and then scrap something rather than scrapping it without even attempting. Again, these are not recommendations and please do not treat them as such. I know I'm painting with a broad brush here, but the idea that I want to highlight is that the combination of trading with investing can increase the odds of a better CAGR over long periods of time. So if I have to consider the example which I shared and try to answer the question we raised at the beginning, trading versus investing, which one makes more money? The truth is it's not one or the other. If you are adequately capitalized, investing gives you the foundation and then layering it with some form of alpha generating trading can dramatically increase the odds of superior returns from markets. The idea of layering is based on the principle of time frame diversification. Take a single index like Nifty. Over the long run, it shows a clear positive drift. But within the larger upward trajectory, short-term trends both upwards and downwards play out frequently. In short, layering is the only way to capture opportunities that occur across different time frames. Now that naturally brings up another question. If trading, especially in the F&O segment, whether through layering or whatever, can add such value, why do so many well-meaning people, including fund managers and industry veterans, actively discourage it? I've thought about it a lot and I've debated it with close friends in the industry. Here are some reasons that I can think of. 1. Let me call it the generational gap. In India, a lot of marquee investors built their wealth in the pre-electronic trading era before the 1990s. Back then, trading happened in the pits and you could make serious money just through information arbitrage, knowing what was happening on the floor before others did. Add leverage to it through systems like Badla and fortunes were made. Now, if that's how you built your initial corpus, why would you bother exploring more complex methods that at best offer paltry returns? Many of these investors never touched options and had little reason to. And that's fair. People naturally avoid stuff that they don't understand. Unfortunately, because most of them became media favorites, their personal biases shaped the mainstream narrative. And that's where lines like derivatives or weapons of mass destruction caught on. Reason 2. I'll call it the fund manager's dilemma. If you look out there, you have fund managers who run mutual funds or PMSs. I've seen 2 clear categories of people here. The first are managers who genuinely don't understand derivatives because their entire careers have been built around long-only investing. The second are those who do understand them, but their products, mutual funds and PMSs, cannot meaningfully use derivatives. Naturally, they discourage what they cannot offer. Interestingly, you'll rarely see a Category 3 AIF manager who can use derivatives speak against them. Third and the last reason, the double-edged sword problem. Yes, I will admit it, derivatives are indeed a double-edged sword, but so is equity if you don't follow rules. Come on, we've all seen people wipe out their savings chasing penny stocks. So the problem isn't the instrument itself, but it's how responsible we are when we use it. That brings us back full circle to our original question. Which one makes more money, trading or investing? Here's my final take. We've all heard and continue to hear about the virtues of long-term investing, and rightly so. But if I were to add a twist, I'd say one of the most underrated approaches of wealth creation is the combination of long-term investing and long-term systematic trading. I actually borrowed this idea from a dear friend and a market veteran who always says long-term investing is overrated and long-term trading is highly underrated. If I have to think about it, that combination might be as close as it can get to a holy grail. And yes, that way we would be borrowing the best of Buffett and Mr. Simons. And lastly, of course, none of this is nearly as easy as it sounds. But then again, when has anything truly worthwhile ever been easy? I hope you found this perspective of some value. I've added a few recommended reads and videos if you want to know more about the concepts that we spoke about or more about both Warren Buffett and Jim Simons. And how could I forget to wish you Happy Dasra to you, and I hope you have fun this festive season. And yes, do share your thoughts in the comments and I'll do my best to respond. Thank you for watching and see you soon.